right, good morning everyone. Nice to see you again. So on Monday, we talked about the world of banking, and we did so through the lens of the balance sheet. And when we were talking about banking, you may recall that there were several places where we touched upon the fact that there are limitations on what banks can and cannot do. In other words, there are many different forms of regulation that affect the banking system. And so today, I want to start to talk about exactly what are the different forms of regulation that there are on banking activity, discuss some of their rationales, and this discussion will then lead us into a new topic, which is the topic of monetary policy, which is going to spill over into next week and possibly beyond. All right, so to talk about banking regulation, I think a good place to start is by means of a little review of what it is that bank balance sheets look like, since they are our lens through which we're understanding how the banking system works. And so let's do that. Remember, banks are just businesses, but their business model is a bit unusual. What they do is that they take in funds from other people or entities. They may also obtain funds by borrowing. And they may also raise funds from the owners. And what do they do with these funds? Well, they do two things. One is that they take these funds and they hold them in different forms, which we call assets. One form, of course, since they are responsible to their depositors, is that they have to hold some of it in some sort of cash-like form in case we show up and want to pull out our funds. But they also lend the funds out, either directly in the form of loans or as securities. And that's what banks do. So of course, banks are constantly trying to figure out what is the right balance between the different items on their balance sheets. That's how they make money. But as a step towards thinking about why banking regulations exist, it's worth noting that banks don't have 100% control over what's going on with their balance sheets. In particular, there are two things that might happen that are not under the direct control of the banks that affect their balance sheets and that they have to manage. And these things also end up, as we'll see, being reasons why there's a lot of banking regulation. So one thing that might happen to this bank that's not under its control is that I might show up and pull out my deposits. So what happens if I show up to this bank and decide that I want to pull out some of my funds? Let's just, for sake of argument, say that I showed up and I decided that I wanted to pull out 10. And I'm just picking 10 because it's an easy number. If I pull out 10, what happens here? And all of this happens instantaneously. The bank no longer has 100 in deposits, it has 90, because now I have the 10 in my pocket. as cash. Simultaneously, that means that the total here is no longer 120, it's 110. Now, when the bank gave me my 10 that I withdrew, it had to give me that in the form of some asset. It didn't just sell me a loan, it didn't just sell me some securities. Where did it come out of? It had to come out of the reserves, because that's exactly what the reserves are. They are cash on hand that the bank can give to its customers when they show up and pull them out. So with these particular numbers, it so happens that the reserves are 0. So you or me showing up to the bank to pull out some of our deposits is an example of the balance sheet changing in a way that wasn't directly under the control of the bank. Now, especially given the numbers that I picked, you should intuitively feel that the bank is probably not happy with this situation, because the bank always wants to have some reserves in order to deal with potential withdrawals. So in the face of this situation, the bank is probably going to react. So the question is, how could the bank react to the extent that there are deposit withdrawals? And I guess if we're thinking about how a bank reacts to something, we have to think about what its objective is. As discussed, the issue here is it doesn't have many reserves and it probably needs some. And we could, I guess, just to make things simple, say the following. Remember that when the bank started, it had 100 in deposits and 10 in reserves. So we could just say, based on that evidence, we could conclude that this bank kind of sort of likes to have around 10% of its deposits in the form of reserves as a precaution. An alternative, actually, is that there might be a requirement that the bank has to have around 10%. But it kind of doesn't make a difference whether the bank likes to have around 10% or is forced to have 10%. Let's just say that either way, the bank wants to have around 10% of its deposits as reserves, just like it did at the beginning. What does that mean? It means that the bank would like to get this number from 0 to 9. So, how could the bank get reserves from 0 to 9? There are 4 ways. Although there are two of them are more important than the others. So how might the bank raise reserves? One is very straightforward. They could just borrow. Right? If you need cash suddenly, what do? You borrow. So one possibility would be to borrow 9, then this would not be 10, this would be 19. This would not be 110, it would be 119. And of course that's 119. And then this is 9. So 1 is by borrowing. And I think I said on Monday, last class, that very often when banks borrow, it's a very short-term loan, maybe even just overnight. And why might that be? That might be because, whatever random deposit withdrawals happen today might be offset by something, by the opposite tomorrow, right? This withdrawal business is probably just a one-off thing. Tomorrow it will be different, and so we just need to borrow overnight to sort of make sure our balance sheet looks good. and tomorrow other random things will happen. We'll deal with it tomorrow. Any questions, thoughts about this? So that's one possibility. There is another possibility. So let's bring this back to where we were, where we had, because I withdrew 10, we have 0 there. I haven't borrowed. We have 110 here and 110 here. So we're back at the situation where we started off with all the black numbers, and then I withdrew 10, which leads to the blue numbers. There is another way in which I might raise the funds quickly in order to immediately get back to where I want, which is I want this number to be 9. And what's that? Well, if you needed money, one thing you could do is borrow. Another thing you could do is sell something that you own. What does this bank own that it can easily sell and turn into cash? Securities. So another thing you could do, to the extent that these are very liquid, would be to sell 9 of them and thus you've converted these assets into cash. So the other thing you could do is sell securities. And the advantage of that, of course, is that you actually didn't change the size of your balance sheet at all. You just changed the mix. So that's interesting because it suggests that while last class we were discussing that securities are useful because, well, they're just kind of another form of a loan, right? It's a funky loan that has this nice property that you can liquidate it if you need it, if you need the money back before the contract expires. Well, this is exactly what makes them useful. They're liquid. You, if needed because of your liquidity management, which is making sure you have enough reserves, you can sell these securities easily. And so that means that as well as trying to pick securities that are going to pay you a good profit, you're also choosing securities based on how liquid they are. And in fact, a big chunk of the securities that are on any bank balance sheet are going to be a very specific, highly liquid kind of asset, which is government bonds, government debt. Why is government debt so common and super liquid? Well, several reasons. One, there's something like $30 trillion in federal government debt out there, so there's a lot of it. But of course, that just because there's a lot of something doesn't make it desirable. So it must have some desirable property that means that people want to hold on to it, which then makes it liquid. And that is the notion that the government is not going to default on its debt. So if that's true, there's some asset that's super common and it's essentially risk-free. Of course, naturally, it's going to end up being very liquid. We'll see if that's true. Hopefully the US will not default on its debt. So those are the two main things that the bank can do to adjust when there is a deposit withdrawal. One, it can borrow. Two, it can sell securities. As I said, there are 4 things they could do, but the others, if you think about them, are things that you would think they'd only do in an emergency. One is that they could, number three is that they could call in loans. And what that means is that you call up people that you lent to and harass them to try and get them to pay you back early. You would only do that in an emergency, right? Because you have these other options that are much simpler. And the other possibility is that you could call up the owners and say, can you please add some bank capital? Again, it doesn't seem like something you would do on a day-to-day basis. So the textbook will mention those things, but just intuitively, those are things for an extreme situation. These things you can do at the drop of a hat. So that's the first example of a change on a bank balance sheet that might not be entirely under their control, although they can react to it in these ways. Now let's use this discussion to think about our main topic of the day, which is about banking regulation. I picked these numbers because they're straightforward and easy to work with. Obviously, you would need a very large withdrawal of funds to literally get down to zero reserves. But suppose you thought that, assuming this is your bank, there is this risk of something like this happening, of a whole bunch of people showing up, pulling out their funds, and the bank running out of reserves. If for some reason you had that belief, how should you react? You, the bank customer. Yeah. You should run there and withdraw your funds first. So that suggests that because the reserves are always just a fraction of the deposits, that there's some sort of inherent fragility here. That if for some reason some sort of panic spreads, where people start to worry that the reserves are running low, maybe because others are running to the bank, then what that does is it gives you an incentive to run to get there first. And of course, if all of us for some reason believed that the bank is going to run out of reserves, and we all ran to the bank to pull out our funds, what would happen? They would run out of reserves. So this scenario where there's this panic about the bank possibly running out of funds, leading all of us to actually run, which then kind of causes the bank to run out of funds, is known as a bank run. And bank runs do happen, have happened. They happened a lot in the 1930s. There were bank runs before that in the 19th century. There were a few bank runs in 2008 as well. So bank runs are a concern. And at the moment I'm describing it as sort of a self-fulfilling prophecy. Like once people start to get anxious about whether the banks have enough liquid assets, then that kind of spirals out of control and leads the bank to actually not have enough liquid assets. But we'll see in about 10 minutes that there's another reason why bank runs might occur that's sort of more fundamental. It's not just a panic. It has a real basis. Okay. So if I were the government, or whichever part of the government worries about financial stability, I would probably be very worried about bank runs. And I might try and think of forms of regulation that might make bank runs less likely. So what kinds of regulations might I think up to try and deal with the risk of bank runs? Well, why is the bank run happening? The bank run is happening because people are worried about the bank not having the reserves to give them their funds. So going back to the beginning here, what's the thing that means that bank runs are possible. It's the fact that this number is smaller than this one. So it's not clear that we necessarily want to forbid banks from having loans and securities, because then, well, we wouldn't have banks. But maybe we want to regulate how much reserves they have to make sure that they don't have too few. So one possibility here, as a form of regulation to deal with bank runs, is to have a reserve requirement. In other words, these reserves have to be at least some proportion of these deposits. Let's say 10%. If we imagine that this bank lives in a world where there's a 10% reserve requirement, are they meeting their reserve requirement? Yeah, they're good. If they had more than 10 here, would they be meeting their reserve requirement? Yeah. So the reserve requirement doesn't say you can't hold more, but it does say you can't hold less. The United States does have a reserve requirement. It's about 10 or 11. The reason it's not a specific number is that the reserve requirements are sort of fine-tuned. What I mean by this. Remember that in the deposits there are multiple different kinds of accounts. We have checking deposits, we have savings deposits, we have CDs under 6 months, we have CDs over 6 months, we have money market accounts, blah, blah, blah. We have lots of different kinds of accounts. Checking deposits are super liquid. You could remove them at an instant's notice if you are the customer. But on the other hand, imagine a 6-month CD. You're not allowed to touch that for 6 months unless you pay a penalty. So intuitively, if I'm a smart regulator, you would think, well, I'm really worried about those checking accounts. Those I really need to have a lot of reserves for. But those 6-month CDs, I don't need to worry about those. They're not going to go out for 6 months. So I want a reserve requirement for those, but not as big. So in practice, the way the reserve requirements work is like that. It's a sort of smart regulation where you have to have, like say, for each dollar in checking accounts, maybe you have to have, I don't know, 30 cents in reserves, but if it's a 6-month CD, you only have to have 5 cents. It averages out to around 10, 11% anyway. Okay? Good. So that's one form of regulation. But there's another. And as I mentioned, reserve requirements don't exist everywhere, and where they exist, they are different percentages. So in some countries, they just leave it up to the banks. Don't worry about this. There is another form of regulation that has to do with dealing with bank runs. And consider the following. The whole reason why there was this possibility of bank runs in this story is that you think the bank is low on reserves, they may run out, and if they run out, you won't be able to get your money back. What if you cut that part off so that even if the bank doesn't have money, you still get it back? In other words, what if we had a system of deposit insurance? Exactly, insurance. And in this country, we do. Anytime you open an account with a bank, with a credit union, whatever, they have to provide you with a document that says this account is FDIC insured or this account is not FDIC insured. What's the FDIC? The Federal Deposit Insurance Corporation. It's the entity that insures your accounts. So there's this risk of bank runs if banks aren't managing their liquidity properly. there are two regulations, at least, that you might have to try and deal with them. One is the required reserve ratio, and the other is deposit insurance. Any questions, thoughts about the rationale behind these things? Now, I said this was the rationale behind these policies, but just because a regulation has a reason for being there doesn't necessarily mean that it's achieving its objective. What do I mean by this? So, anytime you see the word insurance, you should get worried. How come? Because anytime there's any form of insurance, it raises the risk of a problem that is known as moral hazard. So before I explain what moral hazard is and how it relates to deposit insurance, does this term ring a bell? Did you hear about it in micro or not? No. Okay, so it's one of them, again, as I was discussing earlier, there's so much to cover in micro that you can't cover everything. Professors have to make choices. So, let me explain what moral hazard is with a more familiar example of insurance than this one. So let's imagine, or rather, let's think about auto insurance. That's something we're probably all familiar with. In this country, in all states, all drivers are required to have vehicle insurance of some kind or another that satisfies certain minimum requirements. So there are different things that you could be insured against, but almost all things, including driving accidents, that you might be insured against are to some extent under your control, right? The risk of you getting into a vehicle accident doesn't just depend on random factors that are not under your control. It depends on how well you drive or how carefully you drive. So imagine two different places. In one place, there's mandatory car insurance. So all the drivers are insured against the cost of any vehicle accidents. And now imagine a different place where vehicle insurance does not exist. Where do you think drivers are going to be more careful? Here, where there's no driving insurance, right? Because there you got to cover the full cost if anything goes wrong. Whereas here, your insurance company picks up the tab. So that's moral hazard. It's the idea that when you're insured against the costs of a thing, to the extent that that thing results from your own actions, you have less incentive to avoid it. So having the insurance actually makes the thing more likely. This doesn't apply to, I don't know, the insurance against your house being hit by a meteor, for example. That's not under your control. But it's hard to come up with examples of insurance that don't suffer from moral hazard. Let's say flood insurance. How does flood insurance result in moral hazard? Well, to the extent that flood insurance exists, people will build houses in flood zones, making them more likely to have floods in houses. So there's even the possibility of implicit insurance that leads to moral hazard. So by that I mean, think of a really large corporation, let's say General Motors. General Motors makes vehicles, as it happens, and many of their production facilities are in Michigan, which is a very important state in presidential elections, and in congressional elections, I guess, too. It's a swing state. It's up for contest. So suppose General Motors got into financial trouble, which it did in 2008. Is the government going to just let General Motors fail? No, they're going to bail them out. They're too big to fail and too politically sensitive to fail. So there's no insurance against, like General Motors doesn't have explicit insurance against failure, but there's kind of implicit insurance because they're so big and politically important, big in a politically important state, that no one's going to let General Motors fail. So there's moral hazard there, because knowing that you're too big to fail, you might take on unnecessary risks. Because if anything goes wrong, you're going to get bailed out. So again, in pretty much any context in which insurance comes up, moral hazard is there in some form or another. In the case of vehicle insurance, the vehicle insurance contracts are drawn up with that in mind. Because remember, if you do actually have an accident, it's not true that they pick up all the tab, right? There's a deductible, so you still have to pay something, so you do have a disincentive to getting into an accident. There may be an upper limit. So they obviously know that the moral hazard is there. All right, so that's moral hazard in a general context. How does moral hazard show up when it comes to deposit insurance? Well, let's start by thinking, who is insured? We are insured, right? It's our deposits that are insured. The bank isn't insured. We are insured. So if the bank has bad luck or does something stupid, we don't lose our money. What does that mean? It means we don't care if our bank has bad luck or does something stupid. So we no longer care whether the banks that we use are particularly well run. So imagine there are two banks. One is run by very, very careful, cautious bankers. They only invest in the safest of assets. Their reserve ratio is huge, and they only invest in the safest, maybe, government bonds and nothing else. Those bankers probably can't offer you much interest, but one thing you know, your money's safe there. And now imagine the opposite bank. They're going to take your money and they're going to promise you 10% interest, and actually what they're going to do is they're going to take it to Atlantic City and they're going to gamble it all on the roulette wheel. And if they win, great. They pay off your 10% interest, they make their money, everyone's happy. And what if they lose? Well, they lost. What happens to you? You don't care. You get your money from the FDIC anyway. So which bank are you going to pick in a world of deposit insurance? The risky one, right? Because they can promise you something that might work out. If it doesn't, you didn't lose anything because you still get it from the FDIC. So there's a moral hazard. The concern is that deposit insurance is intended to try and make the banking system more stable by making sure that there are no bank runs, because we don't need to worry about bank runs, because even if there is one, we'll get our money back, so why worry? But what it's doing perversely is actually making the banking system more risky, because we don't need to be picky anymore. So as economists, theorizing, we can see that moral hazard might potentially be a problem when it comes to deposit insurance. But as economists, we don't just theorize. We also like to check the data. So I looked up this paper, research paper, written in what was then the top macroeconomics journal by two researchers. The first one is the head of the financial development group at the World Bank. The second one works at the IMF. I think they know what they're talking about. And what happened was the following. The extent of deposit insurance varies around the world. Some places have it, some don't. Among those who have it, some have more generous deposit insurance systems than others. So there's variation around the world in terms of deposit insurance. So that means we can take data from different countries and see whether the presence of deposit insurance is related to more frequent banking crises, which indicates moral hazard, or less frequent banking crises, which means it does its job. And what does it say here? Well, does deposit insurance increase banking system stability? An empirical investigation. That means they're looking at data. Here's the abstract. Based on evidence for 61 countries over some period, they find that explicit deposit insurance tends to increase the likelihood of banking crises. Oh no. So the moral hazard really is there. So deposit insurance is there for a purpose, but it's actually not serving it. Except we keep on going. The more so where bank interest rates are deregulated, okay, that's not important for us, and the institutional environment is weak. What does that mean? The institutional environment is weak. Well, remember my example of the two banks? One which is being super careful with your funds, and the other one which is being super reckless. What if there are other mechanisms to stop banks from doing reckless stuff? That suggests that maybe we want to add a few things to this list of things that you could use to deal with bank runs. It so happens that, okay, so for example, the badly run, the risky bank that we had, remember, that was taking your money to put in Atlantic City and gamble on the roulette wheel. That's not allowed. Of course, how will you be able to check to see that the bank isn't doing something that it's not supposed to do? Well, you would need some additional forms of regulation that force the bank to be informing you or some regulator regularly on exactly what's going on their balance sheets. So I guess we could call that disclosure rules or transparency. In other words, deposit insurance leads to moral hazard unless you have these other regulations that are making sure that the banks can't do silly things with your funds. Or I guess risky things with your funds, to be precise. In the United States, the banks are required to publicly display their balance sheets every day. So hopefully they're not doing anything fishy with our funds. When the paper that I just showed you discusses institutional weakness, what does it mean? It means either these kinds of regulations are absent, or they may be present, but they're not properly enforced. Like weak institutions, meaning, the police doesn't function properly, the courts don't function properly, all that kind of stuff. So in those situations, deposit insurance causes problems. Okay. Any questions, thoughts, comments? Yes?
So is it just that the banks have to the regulation on what they can spend?
That's a good question. We'll get to in about 5 minutes, but yes, right. So I guess that's implicit in what I said, right? Banks aren't allowed to go to Atlantic City. So there are regulations on what they're allowed to do and what they're not allowed to do, which change over time. They used not to be allowed to have shares. Now they are. So all of this discussion stemmed from this idea that one of the things that banks have to deal with that's not entirely under their control is the possibility of deposit withdrawals, and that raised the fear of bank runs, and then there are all these regulations that have to do with that. There is a second set of things that could happen that could change what happens on the bank's balance sheet that are also not under their control. And that's what I want to get to next. So, what else could happen on a bank balance sheet? One is that we might come and withdraw funds. The other, which I think we did discuss on Monday, last class, is that part of the bank's business is to figure out one of it, as we were just discussing, is liquidity management. It has to make sure it has enough reserves, whether by law or because it's being prudent. But the other thing it has to do is it has to figure out what other assets to hold in such a fashion that it's profitable. When it comes to loans, it has to figure out which, when people come and ask for loans, they have to figure out, is this person going to pay me back or not? And how much should I charge them? When it comes to securities, as we were discussing, it's a mix of buying securities that are going to be profitable and buying securities that are going to be liquid. And in either case, the key thing about securities is that their price, as we were seeing last time, changes over time. The price of any bonds they're holding goes up or down with interest rates. If interest rates go up, then the price goes down, and vice versa. And if they have any shares, we saw what the share price of Microsoft looks like. Share prices go all over the place, and they might gain or lose value. Now, if they gain value, what happens to this balance sheet? Suppose something happens, let's say, for argument's sake, that some of these securities are Microsoft shares and they gain value. What happens on this balance sheet? Well, now the total value of the funds this bank is managing has gone up, right? So this total is up as well. But if the total value of everything that's on this balance sheet has gone up, it means not just that something on the asset side has to change, but something on the liability side has to change too. Which item must go up? Well, did depositors show up and leave more funds there? No, so this isn't changing. Did the bank just borrow anything? No, just that some of the assets it was holding gained value. So what does it mean? It means that, so to speak, what's left over for the owners has gone up. So the owners are probably very happy. So whenever there's a change in the value of the assets that the bank is managing, it's going to be reflected in the bank capital. In the case we're looking at, the assets gain value, and so of course the owners are very happy about that. But what about the opposite? What if the securities lost value? And well, let's just pick an example. Suppose some of these securities lost value, and suppose they lost value by 5. Then these securities are no longer worth 150, they're worth 45. So the total value of the assets under management is 115. As discussed, you still owe this to the depositors. You still owe this to whoever you borrowed from. So what it means is that there is less left over once all your obligations are met for the owners, the bank capital. Okay, that's fine. But what if it was not a decline in the value of the securities of 5? Suppose it was a really big hit, and suppose the securities decline in value by 15. So now this is no longer 50, it's 35. This is now a total amount of assets under management of 105. What's the bank capital now? -5. What does that mean? It means that, well, the total value of the assets is 105. The total value of this bank's commitment to other people is 110. It means that if this bank were to liquidate, sell off all its assets, it would be unable to meet its commitments to its clients. This bank is dead, or to be precise, this bank is insolvent. No matter how hard it tries, it can't meet its obligations. And notice that, of course, whether or not this bank ends up being insolvent depends on two things. One, it depends on how bad was this shock that it suffered to the value of its assets. But the other thing was how much bank capital it had. Right? If this bank had had 20 in bank capital to start with, even this massive shock of 15 would not have led it to end up being insolvent. So, just like there are reserve requirements, there also exist capital requirements. To deal with this. So, all banks are required to have a certain amount of bank capital at all times. And if they go under, then the owners have to add some. And just like the reserve requirements, the capital requirements are, so to speak, smart, in the sense that if you're holding very, very safe assets, you probably don't need a lot of capital for those. If you're holding very, very risky assets, you probably need more capital. So the capital requirement does adjust depending on what's on the asset side. All right. Any questions, thoughts, comments? Yes?
How do credit unions work in that case?
How do you what, sorry?
Credit unions?
Credit unions. So when I say the word banks, there are other institutions that also take deposits. So you can widen the net and say that really what we're talking about are depository institutions, which include credit unions, savings and loan associations. Ultimately, what they're doing is much the same. The difference, I guess, is in the ownership structure, maybe. So all of this should apply there too. Right, capital requirements. Now, on the one hand, you might say, okay, Actually, before I go on, notice that before we were talking about bank runs as something that might happen just because of a panic. When a bank has negative capital, this isn't a panic, right? This bank literally does not have enough funds for you. So in this situation, you would get a bank run. Unless, again, you have deposit insurance and so on to try and keep a lid on it. And now, you can imagine something like this happening to a bank just because, again, as we were discussing, either they were unlucky or they made some bad choices, badly run maybe. But when something like this happens, very often it's not happening to just one bank at one time. So let's think back a few years. As I was discussing, all banks tend to have quite a bit of government debt on their balance sheets because it tends to be very liquid, and because there's so much of it, everyone who's in that, all the banks in that country are holding those debts, so holding those bonds, so if you need money quickly, it's easy to find someone to buy them from you. Many years ago, in Greece, there was a situation where, because all the banks in Greece are dealing with each other constantly, and so they all have a lot of Greek government debt on their balance sheets. But now suppose that suddenly the government defaults on its debt and is unable to pay what it promised. Suddenly, it wouldn't just be that one bank is losing, I don't know, 15 in terms of the value of its securities. It would be all the banks at once. So, while this could happen to one bank at one time, it could also happen to many banks at the same time if it turns out that some widely held class of assets dramatically loses value. And this kind of thing happens periodically. It happened here in 2008. It happened in the 1930s. And it'll happen again someday, probably. So such a situation where a lot of banks are being driven towards or into insolvency at the same time, we refer to as a banking crisis. And thus, the idea of capital requirements isn't just to protect any given bank from going south. It's there to try and prevent the risk of a whole systemic breakdown in the financial system, such as a banking crisis. Yes?
Would the situation of Evergrande in China be a banking crisis?
We don't know yet. So I guess the question is, ignoring that particular, going broader than that particular example. Suppose something like this starts to happen. Then the question is, how should the government react? Right, so you may have had your capital requirements, but they weren't enough because something went wrong in a really big way. In the case of Evergrande, I think what happened was they took a lot of funds from people to build construction projects that they were then not able to sell, for which they ended up not being buyers, or they ended up not being able to build them either, right?
They didn't build them.
Right, they weren't even able to build them, but they sold shares in them in things that don't actually exist.
Yeah.
Right. So the details vary from no banking. There's a famous book that came out a few years ago called "This Time is Different." Whenever there's a banking crisis, the details of how it happened may vary, but once it begins, what happened, the sequence is not different. So The question is, once there's a vulnerability like this happening, what happens next? And what happens next is going to depend on the government, ultimately. For example, one thing the government could do is just pour in a bunch of cash, right? What if the government decided to give this company a present of 20? Then suddenly this is 15, this is 125, and then, I don't know, whatever. So that's a bailout. So governments can sometimes try and bail out companies that are in trouble. In my Greek example, of course, the whole problem was that the Greek government was defaulting, so obviously they couldn't do anything. But the European Central Bank and the European Union and the IMF stepped in the Greek case. In the Chinese case, I don't know what's going to happen, but I assume the government is able to come in and bail them out in some fashion or another. I guess we'll see. Any other thoughts, comments, questions? All right. Let me see how we're doing for time. We still have about 20 minutes. So, all this discussion of bailouts suggests that, again, aside from these rules about what banks can and cannot do, a big part of the banking regulation is that there are entities whose job is to try and manage what's going on here. And a key entity that we're going to spend a lot of time talking about this semester that has an important role in managing what's happening in the banking system is the central bank. So we're discussing the idea that it might be important for someone to be monitoring what the banks are doing with their balance sheets. Well, who's the monitor? The central bank, known affectionately here as the Fed, the Federal Reserve System. So what do? Well, they do a whole bunch of stuff. One is they are looking at what's happening in the financial system, not just the banks, but more broadly. They're also looking at what's happening in bond markets and the stock market and so on. What's another thing that they do? Just to sort of recap and reorganize everything. Remember, the first time the Fed came up in this whole discussion, last week, I guess, was because they are there ready to lend to banks if no one else will. And interestingly, in 2020, actually even before that, they don't only lend to banks. They're the lender of last resort more broadly now. And that kind of, given that the Fed is lending to the banks, it's kind of sort of like the Fed is like the bank's bank. Like the way you relate to the banks, you go to them if you need to lend. The Fed is sort of like the counterpart of a bank for all the banks. And that's true in several ways. One, as discussed, if a bank needs a loan and it can't get it from anywhere else, it might go to the Fed. But there's another sense in which the Fed is the bank's bank that's going to be important for our discussion next week. And that has to do with this. So far we've been discussing reserves as though they were just sort of cash that the bank has on hand in case it needs it. But in reality, a huge amount of the reserves that banks hold is not in the form of cash. Rather, all banks have an account with the Fed called a reserve account. Again, the same way you or I might have a bank account at Citibank, Citibank has an account over at the Fed. And those funds that are in the reserve account are allowed to count towards the reserves. And this is actually very useful for the banks because of the following. Imagine that the banks did not have reserve accounts. And suppose I wrote you a check for $100 for some good or service. If you and I shared the same bank, not much would have to happen, right? The bank just has to say, okay, minus 100 Professor Samaniego, plus 100 to you in their computer or on their books. But if you and I did not share the same bank, then somehow $100 would have to physically move over to your bank from mine, which is costly and wasteful. It's wasteful if there's an alternative, which there is, because your bank and my bank both have a reserve account. So all my bank needs to do is send a message to the Fed saying, please move $100 out of my reserve account into the other account. And that can happen much more easily. So you may sometimes see armored trucks driving assets around between banks, but for the most part it's not necessary because the Fed can just take care of it using the reserve accounts. So that's another sense in which the Fed is sort of like the bank's bank because the banks all have an account there, which they use for their reserves. Any questions, comments, thoughts? And lastly, I guess, another thing that the Fed does, which is will keep us busy going forward, is that it determines what's called a monetary policy. And that's, the name monetary policy suggests that it might have something to do with determining the amount of money that there is, and that's true. One aspect of monetary policy is precisely that, the determination of the amount of money. But there's a puzzle that I'm just going to hint at. I'm not going to resolve it yet. Remember when we discussed what money is in this day and age? We discussed that there's M1, M2, there's slightly different definitions depending on how you want to draw the line, but broadly, the money supply is made up of two parts. One is the currency, and the other is the deposits. Where deposits, well, if we're talking M1, we mean checking. If we're talking M2, we mean checking and savings. If we're talking M3, and CDs of certain kinds and so on. Deposits. It's sort of obvious that the Fed or some entity could control how much currency there is. They just need to print it and put it out there somewhere. Typically, they don't shower it from helicopters. When they put out money, they put it out by buying something. But how does the Fed control the deposits? Well, it doesn't directly. What the Fed controls directly, as we'll see, is something called the monetary base. And the monetary base is defined as the currency, which they do control, plus the funds in the reserve accounts. So when we go and think about the monetary policy and how the Fed affects the amount of money, we're going to need to figure out, okay, it's clear that currency shows up in both, but there must be some link between the funds in the reserve accounts and how many deposits there are. And we'll have to make that link somehow, which I think probably is not something that's intuitively obvious. In fact, this is the thing that I struggled the most with when I was a Principles of Macroeconomics student. So I just want to tee this up. The Fed does manage how much money there is, but clearly they can't manage it directly because a huge amount of money is in the form of deposits. So I guess that's probably what we'll start with next class. We'll have to figure out how what the Fed does control ends up translating into a certain amount of deposits. Any questions, comments, thoughts? All right, we have, I think, just enough time for our exit quiz. All right, let's just get cracking. Can't you still sign in? 3, 2, 1. All right, first question. In the instant in which I withdraw money from my bank, what happens? Does its bank capital rise? Its reserves fall? Its deposits rise? Do its borrowings? Its reserves fall because they have to pay you. Next. If the bank has insufficient reserves, what can it do? Can it sell securities, buy securities, decrease its borrowings, or pay dividends? The answer is, of course, that it could sell securities, exchange them for cash. If the bank has insufficient reserves, what else could it do? Increase its borrowings, decrease its borrowings. Remember, it says what else? Buy securities or pay dividends. Again. And the answer, of course, is that it could borrow. Ian's ahead. If a bank sells some government bonds to someone, what happens? Do its liabilities increase, decrease? Do its assets increase, or do they stay the same? And the answer is, of course, that the assets stay the same because you're just exchanging one for another. Almost done. If bank capital drops below 0, the bank is what?
No, I got you one question.
The answer, of course, is insolvent. And last, what is a bank run? Very good. Let's see who won. All right, third is Noah. Nice work. Second is Isaac. And first is Leroy. All right, Leroy. I have a little something for you if you want. Everyone else, nice to see you. You know how to get in touch with me if you want. Otherwise, have a good weekend and see you next week.